Welcome to the Deep Dive. We're the show that tries to cut through all the noise and give you the insights you actually need.
Especially today, right? With finance, there's just so much information flying around.
Totally overwhelming.
Articles, gurus online, endless tips and tricks. It feels like a tsunami of data sometimes. But what if, there was a guide, something timeless, a way to really get the core of smart investing and just ignore the rest?
Exactly. What if you could find wisdom that works regardless of the latest market craze, but also helps you handle, yourself, your own psychology?
Yeah, because that's the real battleground, isn't it?
Often is. That's where you win or lose.
So our mission today, we're diving deep into one of the most influential finance books ever, Benjamin Graham's The Intelligent Investor. We're using the latest edition, the 2024 one, with Jason Zweig's modern commentary.
It's fantastic commentary. Really brings it up to date.
It really does. So we're going to pull out the core ideas that separate real investing from just, speculating, help you maybe conquer those inner market demons.
And give you the mindset to navigate finance with wisdom and, probably need a bit of courage, too. Let's unpack this thing.
Let's do it.
So Graham really started by figuring out this key difference, right, between someone investing and someone just speculating. And he learned it the hard way.
Oh, yeah. Big time. Early in his career, he did all the things he later warned against. Chasing hot stocks, trading way too much, taking on too much risk, even using borrowed money.
Ouch.
Yeah. Cost him. But it taught him, you can't predict the future, especially if you don't have solid data. Trying to is just dangerous speculation.
And the book says right away, if you want to succeed, you kind of have to stand apart from the crowd.
That's the first step. Distinguish your activity. For Graham, an intelligent investor, does their homework. Thorough research.
Right.
Makes deliberate, consistent choices. And crucially, remembers a stock isn't just a ticker symbol flashing, it's a piece of a real business. You own part of it.
Which feels like the opposite of what happens now, especially with social media and apps.
Oh, absolutely. The book nails this. That profoundly human desire to join the crowd, it gets hijacked, amplified like crazy.
You get these financial flash mobs.
Yeah.
Driven purely by FOMO, fear of missing out.
Exactly. You see it on Reddit's Wall Street Bets, where sometimes analysis is almost a joke.
Yeah, or Dave Portnoy pulling Scrabble tiles for stock picks.
Right. Or, those TikTok couples, Chad and Jenny, just cheerfully saying, we just buy a stock going up.
Cluelessly cheerful, it's pure speculation.
Pure speculation. And that leads straight to one of Graham's big rules. Whenever making money becomes effortlessly easy, keeping it is about to become extraordinarily hard.
That hits hard, because you hear the stories.
You do. The book mentions a trader kind of like a casino player, makes maybe $1.5 million super fast on some hot stock, feels like a genius, then loses every penny, ends up working minimum wage again. That's the trap of easy money. It feels great until it isn't.
Okay, so let's unpack this. If the whole world, all the noise, is pushing us towards that speculative, gotta-get-rich-quick thing, how do we even start thinking differently? How do we break away?
What's fascinating here is that the book immediately tells you. You start by realizing a stock's value isn't its price. The market price can be wrong, sometimes wildly wrong.
Okay.
Graham uses this great character, Mr. Market. Imagine him as your business partner. Every day he shows up, offers to buy you out or sell you his share.
Okay.
Some days he's euphoric, crazy optimistic, offers you a fortune for your share. Other days he's utterly miserable, panicked, willing to sell his stake for almost nothing.
So he's totally bipolar.
Exactly. Manic depressive, the intelligent investor, they're a realist. They know Mr. Market is emotional. So you sell to him when he's overly optimistic. You buy from him when he's ridiculously pessimistic.
You use his moods.
You use his moods. You never let your emotions get caught up in his. His irrationality is your opportunity. That's the key shift.
That Mr. Market image is powerful. And it leads right into what Graham says is the investor's biggest fight.
Yourself.
His big insight. You, not the market, are your own worst investing enemy. Our brains are amazing, but man, are they good at tricking us when money's involved.
So true. We tend to zoom in on the potential wins, right? And we kind of conveniently forget about the potential losses.
It's collective memory.
Totally. And that breeds overconfidence. We overestimate how well we'll do, we think we're better than average, that's overplacement, and we get way too precise, thinking we know exactly what's going to happen.
For precision.
Plus, just unrealistic optimism, thinking good things are bound to happen to us. And then there's hindsight bias.
Oh, I knew it all along.
Exactly. I totally called that market crash, which of course just makes you feel even smarter and probably encourages more reckless bets next time.
And the social media stuff we mentioned, it pours gasoline on this whole fire.
It really does. Creates these echo chambers, agreeing with the crowd or the so-called experts online. It literally triggers reward centers in your brain.
Wow. But going against the grain, disagreeing, that lights up the fear and pain centers. It actually hurts psychologically to stand apart.
So it actively pushes people to trade more, follow the herd.
And usually earn lower returns because of it. It's a really nasty psychological trap.
So what's the way out? Graham's antidote.
It boils down to two things, really. Discipline and courage. Building real, long-term wealth isn't flashy. It's slow, steady.
Yeah.
Think about the courage it takes. Imagine buying more stocks after the market crashed over 55% in 2007, 2009. Or just holding on when things dropped 34% in 5 weeks in early 2020.
Terrifying moments.
Absolutely. But those are the moments where real investors prove their mettle. Not by predicting, but by managing their own fear and greed.
Okay, here's where it gets really interesting for you listening. If our own minds and all this online noise are stacked against us, what's the practical toolkit? How do we actually build that discipline and courage Graham talks about? This raises an important question. It starts with admitting you have these biases, these human limits. Then you build a framework, a structure, something that protects you from your worst impulses. And Graham gives you exactly that, especially for what he calls the defensive investor, the person who prioritizes safety first.
Right. So let's get into those foundational principles for this defensive investor. The big one, the absolute cornerstone, is the margin of safety.
Yes, he calls it a cushion of humility. Love that phrase.
Me too.
It's basically the gap between what a business is really worth its intrinsic value and what its stock is selling for. You want that gap to be big. You want to pay way less than it's worth.
The way to give yourself room for error.
Exactly. Room for error. Because you will be wrong sometimes. Your analysis might be off or, stuff happens in the economy.
Right.
Think about Amazon back in 1999. Selling for 15 times its sales, like 10 times what Walmart, a hugely profitable company, was trading for. The expectations were sky high.
Insane expectations.
Totally. So if you bought then, you needed an enormous margin of safety because if growth slowed even a tiny bit, boom, the stock could get hammered. That margin protects you from that kind of unrealistic optimism baked into the price.
Okay, so for the average person who isn't like a full-time analyst, how do you actually build in this cushion?
Well, Graham lays out a pretty simple portfolio policy, the 25-75% rule, basically.
Okay.
As a defensive investor, you split your money between two main buckets, high-quality bonds for stability and leading common stocks for growth.
Got it.
And the rule is you never have less than 25% in stocks and never more than 75%. A simple 50-50 split is often the default, the easiest starting point. This allocation helps you handle the market's ups and downs without panicking.
And then there's dollar cost averaging. People hear about this one a lot.
Yeah, and it's powerful precisely because it's simple. It just means investing a fixed amount of money at regular intervals, say every month, no matter what the market's doing.
Yeah.
High or low, you just keep buying.
You take the timing guesswork out of it.
Completely. And the beauty is, it works whenever you start, as long as you stick with it. You need that discipline, that courage, especially when the market's down. Because what happens? You automatically buy more shares when prices are low and fewer shares when prices are high.
Puts your saving on autopilot.
Multiple levels of autopilot, yeah. Removes a ton of emotional stress.
Okay, another big stressor. Inflation. Always lurking.
Yeah.
How do Graham's ideas help you deal with the eroding power of inflation over time?
Well, fixed income, like bonds, they suffer when inflation kicks up, obviously. Your fixed payments buy less and less.
Right.
Stocks, on the other hand, can get hit hard during big inflation spikes. We've seen that. But over the really long haul, decades, stocks have historically outpaced inflation by a wide margin.
So no magic bullet.
No magic bullet, no single asset is perfect protection. But a smart mix, a diversified portfolio of stocks combined with some inflation-protected bonds, like TPS in the U.S., that gives you a pretty strong defense against losing purchasing power over time.
So bringing this together, for someone listening who wants that solid, steady approach, doesn't want to be a market guru, what's the takeaway?
If we connect this to the bigger picture, Graham's message for the defensive investor, The one prioritizing safety, peace of mind, good enough results is actually really liberating.
How so?
He basically says you can just buy a broad market index fund, like an S&P 500 tracker or a total stock market fund. Hold it for life. Keep adding to it with dollar cost averaging. And chances are you'll do better than most professionals with way less cost and hassle.
Wow. So just buy the haystack, don't look for the needle.
Pretty much. For the defensive investor, that's often the smartest, simplest path.
And to really lock that down, he talks about an investment policy statement, an IPS.
Yes. Think of it like your personal financial rule book, your break glass in case of emergency plan.
Okay, what goes in it?
You write down your goals, your target asset allocation, like I'll aim for 60% stocks, 40% bonds. You define your diversification rules, commit to never using borrowed money, margin debt, and set a schedule for reviewing things.
So it forces you to make decisions ahead of time.
Exactly. It's about structuring your choices based on what you control your savings rate, your allocation, not just reacting emotionally to whatever Mr. Market is screaming about that day. It builds that discipline.
Okay, but Graham also talks about another type of investor, right? The enterprising one.
He does, but he's very clear. This isn't for everyone. This takes considerable knowledge of security values. You need to treat investing like running a business.
Serious commitment.
Absolutely. And he warns there's no real middle ground. You're either passive and defensive, focusing on safety and avoiding mistakes, or you're actively enterprising, putting in the hard work. Trying to be kinda sorta active often leads to trouble.
So if you are willing to put in that intelligent effort, as he calls it, what does the enterprising path look like? And what are the big pitfalls?
What's fascinating here is that the enterprising path is about finding value where others aren't looking, spotting those market mistakes. But it's surrounded by traps, big, shiny traps.
Like what?
Well, Graham warns strongly against getting sucked into high-fee, illiquid private stuff, hedge funds, private equity, venture capital. He saw them as shallow and narrow markets, prone to groupthink, not real value finding.
Okay, stay away from the fancy stuff unless you really know what you're doing.
Pretty much. And definitely stay away from hot issues. IPOs hyped to the moon and SPACs, those blank check companies. They lure people in with crazy prices and promises.
And then the crash comes. That effortlessly easy money disappears fast.
Exactly. Think Nikola. Remember the truck rolling downhill? Turned out to be largely fake. Fraud convictions followed. Or VinFast, the Vietnamese EV maker. Its value briefly soared past Ford and GM combined, despite huge losses.
Madness.
Total madness. Graham called these slaughterhouse situations for the public. Chasing hype usually ends badly.
So where should an enterprising investor look for actual value, according to Graham?
He points to a few areas. One is buying unpopular large companies, basically. Solid businesses that are temporarily out of favor, trading at low multiples of their earnings. Cyclical companies when things look bleak for their industry, maybe.
Finding quality on sale?
Kinda, yeah. Finding solid engines in cars nobody wants right now. History shows this can lead to outperformance. Another area, networking capital bargains.
Okay, what's that? Sounds technical.
It's actually pretty simple conceptually. Imagine buying a whole company for less than the value of its easily sellable stuff, cash, receivables, inventory after paying off all its debts.
So you're getting the buildings, the brand, everything else for free.
Effectively, yes. It's like buying a wallet for $10 and finding $12 inside. Graham found these. He mentioned A&P, the grocery chain, back in 1938. And amazingly, even in late 2023, there were still dozens of these stocks in the U.S. Rare, but they exist.
Wow. Okay, what else?
Opportunity and setbacks. This is counterintuitive. When everyone thinks risk has shot up, maybe a product fails, management messes up, there's an economic scare. The actual risk of losing money on a fundamentally sound company might go down because the price gets crushed.
So fear creates undervaluation.
Precisely. Like W.W. Granger, the distributor. They cut prices aggressively once the stock tanked. But for an intelligent investor who understood the underlying business strength, that was a potential buying opportunity, not a reason to panic.
So to find these, you need to do real analysis. Focus on the business, not the stock price buzz.
Absolutely. Dig into the annual reports, the 10Ks, look at the balance sheet, how much debt do they have, the income statement, are they actually profitable, and crucially, the cash flow statement, are they generating real cash?
Not just accounting profits.
Right. Understand the competition, what management is doing with the company's money. It's business analysis, pure and simple.
And he warns about just looking at earnings per share for 1 year, right? Calls them booby traps.
Yeah, big time. Especially with non-GAAP earnings. This is where companies can get creative, let's say.
Creative accounting.
You got it. Making expenses disappear, making temporary income look permanent. Think Groupon. We work masters of non-GAAP land, making things look way better than they were.
So what's the fix?
Look at average earnings over a longer period. Graham suggested 7, maybe 10 years. Smooth out the bumps, the cycles, the accounting tricks. Get a truer sense of the company's actual earning power.
Okay, so for someone taking this enterprising path, putting in the effort, analyzing businesses, what's one final tool Graham gives them to make better decisions and, importantly, learn?
This is critical.
Yeah.
Use a checklist. Before you buy anything, write down why. What's your reasoning? What are the key factors?
My pilot's checklist.
Exactly. It does a few things. 1, it helps prevent panic selling later because you can revisit your original logic. 2, it makes sure you've actually considered everything important. And 3, maybe most valuable, it lets you learn systematically from both your winners and your losers.
You can see where your thinking was right or wrong.
Precisely. Some firms literally have mistake walls to study past errors. The checklist builds that structured learning process over time. Improves your judgment.
That feels like a really powerful, practical habit. This whole deep dive, it really hammers home Graham's central idea, doesn't it? Yeah. Investing is smartest when it's most like running a business.
Know your business. Keep an eye on management. Have the courage of your research and convictions. Yeah.
He leaves us with that great paradox, too. To achieve satisfactory investment results is easier than most people realize. To achieve superior results is harder than it looks.
It really is. And the toughest fight isn't the market. It's the person in the mirror. It's always you.
It's about building that internal strength, that discipline, and remembering Graham's core truth. You aren't right or wrong because the crowd is with you or against you. You're right because your facts and reasoning are solid. So, the thought to leave you with is this. How often do you truly bring that courage, that independent reasoning to your own financial choices? Especially, when Mr. Market is having one of his really dramatic, emotional days.
Something to think about.
Definitely. Think about it. We'll see you next time on The Deep Dive.